Welcome to Brick by Brick. Join me, Loren Wernette, as I share my personal journey of building a thriving real estate and hard money lending business from the ground up. Along the way, we'll explore the strategies, challenges, and breakthroughs that come with growing wealth. Whether you're a seasoned investor or aspiring entrepreneur, or simply curious about the world of private lending and real estate, this podcast is packed with actionable insights, real-world stories, and mindset tips to help you build your own path to success brick by brick. Welcome to another episode of Brick by Brick. I'm your host, Loren Wernette. Today, we have a wonderful guest with us. We have Adam Williams. Adam works in multifamily, a syndication fund manager out in Arizona. We met through a mutual coach that we had. And when I put a call out for, hey, is anybody in this space interested in being a guest on my podcast? Adam reached out. I've looked through all of his stuff. He's got a very interesting product. It's very different than the fund that I run. And so I think that we're going to have a really good conversation about real estate, investing, and just life in general. So Adam, thanks for joining me on the podcast today.
It's my absolute pleasure. Thank you for inviting me, Loren.
So I give a really, really high level, quick rundown of who you are, but can you in your own words give an idea of who you are, what you do, what's led you to this point, and just kind of how you see the world?
Sure. No, I appreciate that and happy to. A little bit of history on me. I started investing in real estate back in 2004. I started in the single family space and did a couple hundred deals there. And then realized that I couldn't scale it the way that I was looking to scale and grow a real company. And so I found multifamily. I started studying multifamily in about 2006. And once I started investing in syndications, I never looked back. Now I currently manage and run a fund, a private equity multifamily investment fund called Elavest Capital. Our offices are here in Scottsdale, Arizona. We're a very boutique family business. We don't have 20,000 investors on our list. We have a few hundred, but we get really close with our investors. My wife and I are business partners. We have 7 people on our staff, so we're a very tight-knit team. And we believe in that long-term relationship. You know, we get to know our people that invest with us, that trust in us to help them multiply their money and build passive income over time. And we really enjoy it that way. So I don't really see us growing much beyond, 500, 600 people that we work with. And these are people that we're going to build a blueprint for that they can then execute on 10, 20, 30 years into the future to really have that long-term wealth building strategy.
Awesome. So let's go take a step back. Let's go all the way back to 2004, because I'm interested to hear what the transition from, hey, I'm doing some single family homes, like what were those single family home deals looking like? And then what was the tipping point that just said, like, I can't scale this the way I want. I need to do something else?
Sure. Yeah, great question. The way I originally got into real estate was I was running a marketing company back in like 2002, 2003, 2004. And I got invited to a Halloween party of all things by a friend. And I pulled up to the house where the party was being held. And it was the biggest house I'd ever seen in my life. And I was like, oh my gosh, like, what does this guy do? And so I walked into the house, and my friend that invited me to the party, he introduced me to the owner of the home. And I think I was probably 24, 25 years old at the time. It's a long way back. But the kid that he introduced me to that owned the home was 18 years old. And I said, nice to meet you, first and foremost. What do you do and how can I get involved? And he laughed and he gave me his business card and he said, look, he said, I'm in real estate. I'm an investor in a lot of real estate deals. He said, let's, enjoy the party, but call me on Monday and we'll get together. And sure enough, I hit him up, I think crack of dawn Monday morning, and he invited me into his office and I sat down with him. And he owned a mortgage company, but he said, look, I don't make my money in mortgages. I do okay there. But he said, I make my money in actual real estate investments. And he went on to tell me that he was investing in Liz pendants, notice of default, pre-foreclosure, and then also buying tax foreclosures at the county steps. And so I said, cool, how can I get involved? Sign me up. He handed me a stack of papers about an inch thick. And he said that this is a list of all the notice of defaults that came out. He get these lists from the title companies. And he said, go home. It was thousands of names and addresses. And he said, and phone numbers. And he said, I want you to go home. I want you to cold call every one of these people. I want you to use this little script he gave me, book an appointment, and I will get on the phone with them and see if they're a fit for what we do. And I said, sure, easy enough, right? I had been on the phones all my life at that point, selling stuff. So I went home, I started to make those phone calls, and I spent about a week calling through that list probably 3 times. And guess how many deals I got out of that?
1.
0. Nobody wanted to talk to me. Everybody was like, absolutely not. Hang up, all the cold call stuff, right? A lot of unchoice words. Don't ever call me again. And so a little bit frustrating, but I said, there's just got to be a better way. So I didn't have a bunch of money at that time. I literally had a few $100s in cash and, my business was struggling and whatever. And so I literally took the last cash that I had and I went and I bought a couple rolls of stamps. I bought envelopes from Office Depot, the big boxes of envelopes. I bought some printer ink and paper. And I went home and I created my own direct mail piece. And I just used every last stamp that I had and every last envelope that I could afford. And I hand wrote every envelope and put a real stamp on it. And I sent these out into the mail. And within about 3 or 4 days, I started getting some calls coming back in now from these people. And out of those calls, I think I probably took, 20 calls, 30 calls. Out of those calls, I closed one deal. And that one deal made me $9,000. And I thought I had hit the lottery. I said, man, if I can make $9,000 on one deal from sending out a little piece of direct mail and getting some phone calls back in, I am in heaven. So went back to him, struck a deal with him to do all of his marketing at that point. And he would do the deal. He would structure the deal. He would handle all the real estate side while teaching me so I could learn what he was doing. I would handle all the marketing side. And we did a 25%, 75%, basically a handshake deal where I would get 25% of the fees. He would get 75%. We would move forward. Over the next 3 years, we did 252 of those. And I grew it to where we had a pretty large machine running. I had a 70-seat call center out in Orange County, and we were doing about 30 deals a month. We got to a point where, unfortunately, the bank stopped lending money in late 2007, and all of the deals that we had on the board at that time in escrow, not a single one closed. As that business got completely pulled out from under me, I had already been studying multifamily. Once we got to about 2000, I was around 150-ish deals in, and I was making incredible money for me at that time. But I realized there's no way I'm going to get to really be able to scale this thing without building a massive team, a massive infrastructure, and also knowing that single family, especially in what we were doing, was very emotional. These are people that were behind on their bills. They were losing their homes. And although we had structured a program where we were trying to help them and save them and rebuild their credit and get them to keep their homes, it was still a very emotional ride for those people and a lot of crying on couches. And, it was tough. So I didn't want to be a part of that business anymore. I knew I wanted to phase it out. So I paid a guy $20,000 here in Arizona that was deep in multifamily. He was one of the original kind of people out here doing a really good job at it and having success. I paid him $20,000 to teach me everything he knew. And this was back in 2006, before coaches and, mentorship programs, none of that existed. And so he agreed to take me on under his wing, and I attended kind of his multifamily college, so to speak, and learned everything about, acquisition, disposition, forcing appreciation through NOI growth, cap rates, right? All of the things that you need to know going into it, tax strategies and all of the things. So I knew that I wanted to get involved in multifamily, and my goal was, okay, I'm going to go become an operator, and I'm going to acquire 10,000 units over 10 years, and I'm going to be off into the sunset, right? But when the banks stopped lending money on residential, $200,000 loans, there was no way I was going to get $20 million loans done. And so it kind of all was like, oh my gosh, what do I do now? And so I just started investing in other people's syndications because I had made a lot of money in the business I was currently running. And I said, well, if I'm not going to the timing isn't right for me to go become an operator and, acquire all these assets myself. Let me at least get in the game with the knowledge that I've learned here and start investing in other operator syndications so that I can at least begin to really understand the nuts and bolts of how this works. And that's how it all started.
Awesome. So 2 things. First, can we level set just the audience of define a syndication just in broad terms? And then I'll have one other piece, but do that first.
Sure. Yeah. So a syndication is really simple. If you're going to go, I'll give an example. If you're going to go out and acquire a $30 million 200 apartment building, generally a single individual is not going to be able to stroke a $30 million check to acquire that deal. So a syndication is simply we set up a fund structure and a bunch of investors pool their funds together to go acquire that deal.
Perfect. So I want to take a step back. I think you glossed over some three pieces that you did that most people wouldn't do when you were getting started. First, you met someone and they told you to call you on Monday. Immediately, you called them on Monday. Most people would have skipped that step. They, oh, he doesn't really want to talk to me. Second, he gave you a list of names and phone numbers and told you to call them that was this thick. Most people would have said, I'm not doing that. That's a lot of work, right? And the third thing is when no one wanted to talk to you, you went further and sent mailers out to them and that was what actually got you that first deal that got you going. So you basically had to do three things that most people would have never done. They would have never gotten past one. So what was it in your nature or in your upbringing that gave you the push that just keep driving at those three things that most people wouldn't have done?
Yeah, great, all great questions. And a fourth thing on that, when I took that last few $100s that we had, my wife at the time, I was married, and she about killed me because she's like, "Are you out of your mind? You're gonna go spend our last bit of money on, like, we don't even know how we're gonna pay our mortgage payment this month, and you're gonna go spend this money on stamps? Like, are you crazy?" So, and then she was happy, of course, when it all worked out. But yeah, all great questions. Listen, Loren, I've always been of the mindset of so what, now what? It's just kind of how I run my life. You're going to get punched in the face. Stuff is going to test you. You're going to jump over a hurdle just to hit the next hurdle. And you're right. Most people do give up. They don't take that next step. And I think you really have to be of the mindset that, like, what if I don't take that next step, right? What if I didn't make those phone calls? And it was thousands of those FUs, hang up, never call me again, you're a POS. What if I took that as, oh, this isn't for me, right? What if I didn't go buy those rolls of stamps? And so with that, it's just like, it didn't work out. Well, that doesn't mean no. That means, how can I get it done? Right? How can I make this happen? I'm watching this 18-year-old kid live in a multi-million-dollar brand new home that wraps around the mountain. That shows me it's possible, right? That shows me it's possible. He's doing it. I'm watching him doing it. He showed me when I went to his office all of the deals they currently had in escrow. He's doing it. So why am I going to give up just because I got a few people that told me no, or some hurdles to jump over? And I'll follow that up with even now. Look, that was over 20 years ago, but even now, my follow up is relentless. When I say I'm going to do something, when I go to an event and I meet somebody cool in an event, and I say, hey, cool, let's exchange contact. Let's get golf on the books. Let's get a lunch on the books. Let's get a coffee on the books. Come into my office. Let's have a meeting. You bet your ass I'm following up, where most people don't. I've got an amazing assistant that holds me accountable, that we do a sync every single morning. I actually used our coach's EA training, and we actually, man, it was a lifesaver. So she has a really good accountability, and she is my backbone to hold me accountable. But follow up, because I'm telling you, you will stand out amongst 98% of other people if your follow-up is just relentless. And I don't mean annoying. I don't mean bothering people. If they're not interested, leave them alone, right? But at least if you say you're going to contact somebody Monday or the next day or whatever it is, contact them. What's the worst that can happen, right? So that's it. Follow up, do what you say you're going to do. When roadblocks hit, jump over them. Get ready for the next one. We get paid really, really well for creating solutions to problems. That's it. It's the name of the game. So,
and I'll add one more to that is consistency, right? You have to do all those things, and you have to consistently do it. So
yeah.
Awesome.
I got a fun story for that. I'll tell you, for your audience. It's really cool. So I know you just released your show. You guys just got started this year with your podcast. Congratulations. It is not easy. And we just started our show. We just dropped our 6th episode. We started April 22nd for the Mint Project. Anyways, I've got a really good friend. He's a real estate, one of the GOATs. He's become a great friend, mentor, etc. And he started his podcast 12 years ago called The Science of Flipping. His name's Justin Colby. A lot of people probably know who he is. He's done thousands and thousands and thousands of real estate deals. But when I went to start my podcast, he said, Adam, I go, Justin, give me some pointers. And he said, consistency. He said, treat it like a business. Don't expect it to start making you money month 2. Most people, I don't know what the exact statistic is, but they give up after like their 7th episode or something. And he said, Adam, I ran the Science of Flipping podcast for 10 years before I started getting anybody to pay attention to it. And now he just started his 2nd podcast, Entrepreneur DNA, and he's absolutely crushing it. I mean, he's got Cardone on. He's got like everybody is on his show now that you would want to see, and he's monetizing his podcast. And he's like, I treat it like a business. It's a business. And I was relentless when nobody even knew what the hell podcasts were. I just kept doing it. Right. So it's just one example of why, like, look, man, nothing happens overnight. I always say this to people, to new entrepreneurs coming up. Whatever timeline you think it's going to take for your business to see success, triple or quadruple it, and triple or quadruple the amount of money you think you're going to need to spend to get there, and you might be close. It's just everybody wants everything today. Yesterday, they want to make millions in day one once they put their Instagram story up. It just doesn't work that way.
Yeah. I love the Alex Hormozy quote that's like, everyone knows that being a business owner is hard, and it's still harder than you think,
Yeah. I love Alex. He says, my favorite thing that he ever said was, being an entrepreneur and running a business is like getting punched in the face over and over and over again just to get a little glimmer of success and get kicked in the nuts the next day.
So true. So true.
So true.
All right. So we're now circa 2007. We're just about ready to get to the market crash, or the market has started to crash now. So walk me through what it looked like for you during that kind of tumultuous period in real estate.
Yeah, cool. Yeah. So luckily for us on the residential side, we didn't get hurt. We may have lost a couple of properties out of the hundreds that we had done deals on. But the way that those deals were structured is we had different investors in each property. They were actually structured with the program in place to where the actual homeowner that we helped out could buy their home back inside of 2 years. They had an exclusive right to be able to do that. And so it wasn't like, oh my God, we have 250 rentals and what are we going to do? And we're losing these things. Those acquisitions were all completed. So the banks falling out didn't really bother us. The values taking a dip, sure. Yeah, that sucked, right? But it wasn't like our backs weren't against the wall, because every one of those had a tenant in them that were really had a lot of motivation. They were the original homeowner, right? It wasn't like we found a new tenant that was just renting. These people had motivation to make it work. And so we did. We worked the next few years to just kind of keep them in those homes and paying that payment as they could. And so that's on the residential side. On the multifamily side, the really cool thing about multifamily, if you go back and you look at the charts from that time, is that whole blow up in real estate didn't affect multifamily. I mean, we may have dropped 1 or 2% in values at that time in apartments, but it was all focused on single family because the banks were lending to people that shouldn't have got loans for way more than they could afford with these adjustable rate mortgages, right? So when I moved over and started investing in other syndications, it was great. I didn't really feel anything. And the operators of those deals didn't really have any issues. They had to raise more equity, right? Because they were able to get less debt on those deals from the bank. But that was okay. That just gave me more opportunity. So I didn't really feel it like a lot of the guys that were flipping houses and relying on like rentals and things like that. I got really, really lucky to be on.
That's good to hear. I mean, you hear there's been a huge influx, at least in my community, of people that have come into real estate, including me, since like 2020, right? 2019. And so there isn't a ton of people that I talk to on a regular basis that lived through that. And the ones that did have a very wide range of how their lives were affected. Everything from I lost everything and had to start over to it barely touched me. So it's always interesting to hear how that affected people. And then if you did live through it, the next question I always ask is like, what did you see during that has shaped your opinion or shaped how you do things today? And as we look at what we're going to see in the next 2 years, what we've seen in the last year, how is it impacting what your business is today?
Oh yeah, all great questions. So no, I learned a lot, and I'm now over 20 years in, and this will be my third market cycle. And although, I focus solely on multifamily now, generally larger scale, Class B value add deals. The one we're doing right now is 200 units. I still pay attention to the macro environments. I pay attention to what's going on in single family. I pay attention to what's going on with development, because it all kind of affects everything that we do, as well as like LP sentiment, right? Like investor sentiment, right? You got to follow what's going on with the broader markets and what's going on with stocks and Main Street or Wall Street as well, right? But for me, our outlook specifically, and again, when I shifted over to multifamily, I shifted over. I do nothing in single family anymore, zero. And I'm not saying single family is bad. I have colleagues and friends that are having great success, doing what they're doing in single family, wholesaling and flipping and rentals and BRRRR and all the things that they do. Awesome. Just not my game, and I like to stay laser focused. But in multifamily syndication, specifically what we do, the value add, There's a few things here. I just recorded a YouTube video with a gentleman by the name of Jeremy Dyer last week, and I called it The Perfect Storm. Maybe you guys can link it in the show notes. But I truly believe, and I started studying this, it's on my YouTube channel. I started studying this back in about October of last year. And I said that the perfect storm in multifamily is kind of brewing. And here's why. As we saw it hit its peak in 2021, on mid 2021, where values were the highest they had been in this market cycle. And I saw a lot of syndicators and a lot of operators eating up, 10, 20 assets a year. I mean, they were just buying up everything at like super high values. I said, there's going to be a fall apart here that there's going to be some opportunity a few years from now. And sure enough, a lot of the guys and gals that were acquiring these assets between like June of 21 to like July of 22 or even end of 22 are now getting really hurt, and they've lost a lot of investor equity because what's happened is those 3-year rate caps that they bought, if they were smart enough to buy a rate cap, have all begun to expire. So this debt is coming due. Meanwhile, the value of their assets has come down 20, 30% off the highs of where they acquired it at. So they're unable to refinance these assets, and they're not able to service the debt. And we're seeing these things getting taken back by the bank, and we're able to acquire them. The first thing of this is just that. The current asset that we're acquiring, 200 units, Charlotte, North Carolina, right now, it's a $31 million acquisition. We raised $15.7 million in equity on. We're getting that asset at a 26% discount, right? 26% off discount of what we would have been able to buy it for 18 months ago, and discounted off where all the comps are currently in the area. 26%, massive. Number two with that, you're starting to see, and I go through this in that video that I filmed, you're starting to see the supply versus demand or supply versus absorption level back out this year in 2025. Or in 2022, 2023, I greatly outpaced demand because of all the new builds and all the construction that was happening and all these new apartment buildings coming online. And so we weren't able to increase rents. There was a lot of issues going on and challenges over the last few years. But if you look at the chart, and this is all CoStar reporting, in 2025, we're pretty much even on supply and demand, finally back to even. And 2026 and through the remainder of this decade, demand starts to greatly outpace supply because now all these new assets have come online, all this new products come online, the concessions are burning off, and the demand is still here in the areas that we invested. That's the second thing. The third thing is organic rent growth. So we saw organic rent growth go in the negative for the first time ever in the markets that we invest in over the last couple of years because of the supply versus demand issues. And now you see it again in 2025. We're right back into positive organic rent growth. And through the rest of this decade, it continues to increase in the positive organic rent growth space. So for multifamily operators or syndicators like me, it's perfect because we now can start to begin increasing those rents with inflation, which is what we should be able to do in the broader markets, right? And then the fourth and final thing for the perfect storm is we've just heard made mention by the Trump administration that 100% bonus depreciation is back on the docket. Now, it hasn't been voted in yet. There's no guarantee that it will come alive, but we're 99.9% sure that it's going to happen. And if that does happen, it's looking like it's going to retro back to February 20th of 2025, which would just be gasoline on the fire. So those four things coupled together are creating this perfect storm that I talk about for multifamily investors. Even if you're just an LP investing $100,000 in a deal, I've never seen in my lifetime, and I don't know that we'll ever see again, this opportunity that we have right now in front of us.
There's so many points to talk on right there. I think the first one I want to mention is, as a normal person that's not in the industry that we are, drives around and they see all these apartments getting built, and then they hear like, oh, there's too many apartments already on the market. Why are they building this new one? I think the thing that people forget, and I deal with a lot of the builders, right, in my side of the business, is those projects are 3 years to year and a half to 3 years out. So those plans happened 3 years ago when there was a huge demand for, think happened 3 years ago. You're just coming out of COVID. economy was still pumping. People were moving out of single families, needed more housing. And there's all kinds of plans for multifamilies, townhomes, all these. Now those projects are coming to fruition. And then you get this big burst of units available to rent, drops the market. And so people forget about that piece. But then as you have, like last year, we saw way too many units available for rent. Think about what's going to be in 3 years, because nobody was looking at building apartments in 3 years from now, besides like the massive ones that their whole bread and butter is building it. So there's cycles in everything, even in real estate, even in the subsector of multifamily, apartment rental pieces.
That you just nailed it. Yep.
So as we talk about more of what you were just mentioning, the components of how that impacts the overall economy and how an investor looks at that. Talk to me about, if I'm an LP and I am looking at a syndicate and I'm looking at depreciation versus putting money in a stock market or putting money in a debt fund like I have, or putting money in gold or something, what are some of the factors or considerations that someone should look at when they're looking at their own personal situation and where they should place their money, assuming that they have a desire to do some alternative investing in real estate, or as opposed to just dumping into a mutual fund?
Yeah. And I'll just say, look, I'm not here to give financial advice. I know everybody's situation is different and what everybody kind of adheres to is different. And that's super cool. I'll just talk about what I do and why. And a lot of the investor calls that I have for first time syndication investors, what questions they're asking and kind of their why. I personally pulled out of the stock market back in my early 30s. I had some money with a brokerage, and it was like, invest in these whatever, stocks. And I'm in Anheuser-Busch, and I'm in Philip Morris, and I'm in Coca-Cola. And I'm like, not only do I not care about any of these things, but like I have no levers to pull. There's nothing. Like I literally it's a hope and a prayer for me. And will they go up and to the right over time? Historically, yes. Cool. But I'm more like, I want to be in the game, right? I want to be able to pull some levers that are going to make the difference. And there's risk in everything. We just saw it happen, last month, where I'm getting calls from a lot of our LPs that's like, hey, I want to get in Fund 59 with you. But man, my portfolio just took a 30% dive last week, and I got to like shake it off, right? And they're stressed out, rightfully so. And I'm not saying there's not risk in real estate or multifamily syndications. There is absolutely risk in everything, right? There are operators right now losing all their investor equity, 100%. Put in 100 grand, gone, will never come back. But that's, in my opinion, because it is a hard asset, because you are an equity owner in these types of deals, it's on the lower end of the risk spectrum for me. Right. The other thing that is kind of a differentiator for me and most of our investors is, because you're an equity investor in the multifamily syndications that we do, you participate in the depreciation, in the tax write-offs. And for us, every time we acquire a new asset, we immediately do a cost segregation study, which helps us maximize the tax benefits for our investors. And so we pass through that depreciation and that accelerated depreciation so that we pay monthly distributions. So that if you're getting $500, $600, $1,000, $10,000 a month into your bank account as a passive investor, and it's structured properly, and again, this is not tax advice, talk to your tax professional because everybody's different. But myself, I invest in every one of these deals alongside of our investors, and I don't know any of our investors that actually don't earn that passive income completely tax-free because of the pass-through depreciation. So if I'm getting $1,000 a month passive income before I get out of bed from this type of an investment strategy, because I'm in a couple of these deals, I'm keeping $1,000 a month. I literally don't have to ship part of that off. And not only that, the depreciation that we have is enough that it offsets even more income that I'm earning from that pass. So I'm able to push that through depending on your earnings and your tax structure, of course. And then I don't want to, confuse anybody, but if you get into rep status where you're an actual real estate professional, you can also take some of those passive losses and offset some of your active income. So there's these tax strategies and these tax benefits that you're able to participate in that I don't know any other investment type that you're able to do that with. And the other thing that we do is every time we exit a deal, so we acquire the new apartment complex, we run our business plan, we increase the NOI, and we sell it for profit 3 years, 4 years later, whatever we do. Our investors have the ability to take their principal and profits and leave, go pay the taxes on them and do whatever you want. But over 92% of our investors choose to 1031 exchange that into the next deal. So now, not only are they keeping their passive income every month that they're receiving tax-free for the most part, but they're increasing, they're compounding their returns over here every time we exchange into a new deal, tax deferred. And if they set that up properly, they can step up their basis so that when they're no longer on this earth and we die, we can pass that on to our heirs tax-free. And so we created some tools around this that we work with our investors on. Happy to show anybody that's interested, happy to do a call with you if you're interested in seeing it. But, as opposed to like a debt fund, which I'm invested in some debt funds, I actually have some good friends that run some really good debt funds. And why I like the debt funds, although you don't get the depreciation, you don't get the tax write-offs like we do with the equity funds, but with the debt funds, you generally get like a higher annual cash on cash return, right? So in some of those debt funds, you may be getting 8, 10, 12% cash on cash, which is great. I like to kind of do both with a weighted more on the tax side for my equity fund stuff. But, to each their own, like I said at the beginning of this, when we get new people that come into their world, I talk through, what are you looking to achieve? What are your plans? Let's look out. I would say real estate investing is not a get rich quick scheme. It's a get wealthy for sure blueprint. But the real value is 10, 20, 30-year plan. So the more time you have, I talk to guys that are in their 70s that have already made their money that want to work with us. And I talk to people that are in their teens that are just getting started that want to work with us. Everybody has a different plan. So let's talk about your plan and what you're looking to achieve. And then let's map out a blueprint that maybe you're in the market a little bit, right, in Wall Street. Maybe you're in some debt funds. Maybe you're buying some gold as a hedge or Bitcoin as a hedge. And then maybe you're doing some syndications with us. And we just kind of look at it. And I tell them all the time, like, I'll help you talk through it. And then you go talk to your advisors and you get the rubber stamp and the green light on what you want to do. And then we're happy to facilitate those portions we can help with.
Awesome. So just a couple of definitions for our guest or our audience here. So when he talks depreciation, IRS basically says that every building has like a 27.5 year lifespan. And so you divide it by 27.5, and that's how much you can take off of the value. Then he mentioned cost segregation. Cost segregation has the IRS puts a value or a timeline on everything within the building. So the flooring, the walls, all the things. And so you can basically have a company come in, pay them. They will go through the building and highlight every single one of those things and then give you a big number that you can then depreciate on the annual basis. Now, I think a good point to mention, I ran in this when I was trying to buy mobile home parks a couple of years ago, is the cost segregation and depreciation recapture when a sale happens, right? Which you can get around with the 1031 exchange. Not a tax professional, not a legal professional. I'm just putting the information out there. Talk to your representatives about that. Going back to the syndication and like the types of property. So like as you're looking for these types of property that can get you the depreciation, can get your investors these returns, what are you looking for in the property? And what are some common things that you see, this operator, they could be doing X, Y, and Z, and that's how we're going to increase the value, because the value is basically determined by the net operating income, which is how much income you're bringing in versus how much you're spending, right? And so you either cut costs or you increase income. And so what are some common things that you do when you take over a building or that you see could be improved when you're looking at these properties?
Yeah, and that's a great question as well. Both actually. So cutting costs, cutting expenses, and increasing income. So we're looking to do both. I'll just give real life scenario. We partnered with an operator. We're on our 59th acquisition right now, and knock on wood, 59 deals, 11 exits, never lost an investor dollar, never missed a debt payment. And when we go into these acquisitions, which we'll do 10 to 12 deals a year, so we're very active. This is all we do. We're laser focused. It's very rinse and repeat for us, but it's also needle in a haystack. So on the deal that we're currently finishing up right now, we had to underwrite nearly 800 deals to get one that worked in our model, right? So it's very, very needle in a haystack. They have to meet a lot of parameters. The data room is deep on these deals. And what you're looking for, what we try to solve for, we're always looking at it is trying to solve for four things for our investors. We're trying to solve for 15% or higher internal rate of return, IRR. We're trying to solve for a 4% or higher average cash on cash return. We're trying to solve for a 2x or higher equity multiple. And we're trying to solve for 20% or higher average annual return for the life of the deal. So what all that means is if you come in and you invest $100,000 into one of our syndications as an investor, we want to get you a minimum of $200,000 back, that 2x equity multiple or higher. We want to get you an average of 4% or higher cash on your money, monthly distributions, but 4% or higher. And we want to get you an average, like if we hold the deal for 5 years, which is, we have never held a deal for 5 years, but that's our time horizon. If we hold a deal for 5 years, we want to make sure you're making at least 20% a year on your money by the time we sell the deal. And those are the 4 things. So if we can make those numbers work with an asset that we're looking to acquire and everything works for the operator, we'll go ahead and take the deal down. The method of operation there is we acquire, once we get a deal awarded to us, right, from a seller, we go through final negotiations, we get a deal awarded to us. We have a 30-day deep diligence time frame where we go in and we're doing deep dive diligence on the deal. And then, of course, as soon as we're done with that, we go ahead and complete the purchase and sale agreement and move forward. Once we acquire the deal, we hit the ground running. So our operator is fully integrated. They own the construction company. They own the property management company. They own all of the acquisition and disposition teams. They have over 300 employees. So even though as a fund, as a private equity fund here, I only have 7 employees because we've just raised the equity on the deal, they literally handle everything from A to Z. And every deal that they invest in, every market that they invest in, which we're in 4 markets currently, they have not only their corporate office here in Arizona, but they have an office in every single market that we're in and a warehouse in every single market that we're in that houses all of their supplies. They control the supply chain for all the materials. Because for us, it's just rinse and repeat. When they get in a deal and this one's 200 units, we're going to renovate 100% of those units. They literally, every kitchen and bathroom is exactly the same, right? It's the same exact scope. It's the same exact renovation. They just stamp them out as quickly as possible. And so I truly believe that's what allows us to be successful, is having those systems in place that we've now executed 58 times up until now, and just having all those risk mitigation practices in place, right? To where, like, we're relying on us. We're not relying on outside vendors and outside things for the most part. One of the big questions that I've been getting recently is, well, what about the tariffs and how's that going to affect the renovation supplies that you need? I'm saying, great question, but we thought about that a year ago, and that's why we have a warehouse in every area, and we have all of the supplies for the next 2 to 3 assets already procured for those renovations. So I hope that helps answer kind of the systems and how we work and all those
It does.
things.
I mean, it's such a huge advantage to have that and that team because, I talk to a lot of investors or new investors to funds, right? And most of the time those conversations start with, well, I would like to buy some rentals so I can have passive income. And I had 65 rentals at one point, and I've since sold all but 3 of those off. And there is nothing about owning a rental that is a passive investment. And when you do, just like anything, if you start something, you do one thing, it is far less efficient than if you do 100 of those things, right? Because you don't have the supplies, you're doing everything one off, you don't have systems and processes. So having somebody like you that already has a team in place in every one of those markets that has all the supplies. Oh, we need to do new flooring. Already have enough flooring for every unit in this whole building to come in. We need paint. We have a crew of painters. You're not waiting to find someone to come paint and get estimates. And it makes the process smoother. It makes it cheaper, and it gives you better returns, which you could then deliver to your investors on the backside, right?
Yep. Yeah. And economies of scale, right? If you're renovating 200 units rather than one single family residence, you're going to get that economies of scale, and you're going to decrease your costs and your exposure there. And then on the flip side of that, and trust me, I came from the rental game too, and it is brutal. I have clients that come to us every single week right now. I own 10 units, I own 20 units, I own 30 units, and they're just beating their head against the wall. And it's risky because, unfortunately, if you own a single family residence rental and an HVAC unit goes out, you just crushed your cash flow for the year or 2 years or 3 years. A tenant moves out, you just crushed your cash flow for the entire year by maybe missing 2 months while you're getting a new tenant in there or doing some repairs. And there's just, look, unless you're a massive, massive, massive player or institutional, there's just no way to really effectively scale that business that I've seen with people without beating your head against the wall and taking a lot of risk. Where with us, 200 units, we have 3 people that move out. You don't even feel it. and you never get a phone call from a tenant, and you never have a repair, and you don't do anything. It's completely passive. So it just doesn't make any sense. You know what I mean? To go the single family rent. I think it's a misconception. Everybody that's new thinks, well, I got to go buy a single family home and make it an Airbnb or a rental. And it's just not true.
I think there's some mental, not a flaw. There's the mentality about having your hands on it and like the control you feel of doing it yourself, even if maybe the numbers don't make as much sense as putting in with a professional manager of a fund or of something else, right? But people like to just do things themselves. There's some feelings around that, but I also think that there's a control piece, and there's a lot of my last podcast I talked about with somebody that we talked about businesses, and one of the main pinch points that businesses have that stop them from getting bigger is the founder is the person that has to do everything. He's unwilling to relinquish control of things, and that happens on single family too. You are the person, you're trying to do everything, and all of a sudden you get like 10 units and you're overworked, you don't have time to do everything, and now all of a sudden you hate it and you want to get rid of them. Now, if you put systems in the process, you maybe could have scaled past that, but you would have hit another pinch point at some point, because it's just not feasible to have 200 units underneath 200 different roofs.
That's right. Yeah, I'll tell you, in my 20 plus years of doing this, I've probably spoken with 100 people in this scenario, and I've never met one person that owns 5, 10, 20, 30 rentals, single families, duplexes, whatever, that tells me that they're happy with the way that it's going. Not one, not a single one. Matter of fact, they're calling us to figure out how to phase out of those and move into syndications.
Yeah, I have seen the same thing, right? So you basically have people that have no rentals, you have people that have like 5 to 10 rentals, and then you have multifamily owners.
That's it.
Or syndicate LPs. So
yeah. That's exactly right.
All right. So talk to me a little bit about like your investor pool. Like if someone was interested, and you don't need to pitch me, but somebody was interested in investing in a syndicate, whether it's yours, or what should they be looking for in the syndicate, or more importantly, in my mind, in the person running the syndicate?
Yeah, you nailed it. So I was going to say exactly that. It's so simple, honestly. Vet the operator. You are betting on that operator to execute the business plan. You are handing them over your hard-earned dollars, and you have zero control. And you mentioned it a moment ago. That's the one thing that scares people. There's 2 things that stop people from investing in multifamily syndications. Number 1, they don't have the means. They don't have the money to do it. And number 2, they don't trust you, right? And neither one of those are wrong. But if I'm a brand new investor, this is my very first time, I'm going to go out and say, hey, I want to get into this syndication thing. Vet the operator. Go to their office, look them in the eye, ask all the difficult questions, get on a Zoom with them if you can't go to their office, face to face. You know what I mean? If their communication style is wishy-washy, if they're, it seems like they're not being completely upfront with you. Look, in most states, all of this stuff is public record. Don't take what they just tell you. Go check it. Go fact check it. We're 59, and I tell people, don't believe me telling you that. Go look. Go do your own deep research, right? A lot of operators out there have blemishes on their track record, and I would just say that you don't necessarily, it doesn't mean they're bad. It means they had a hiccup. How did they handle it, right? How did they handle that when the crap hit the fan? Those are the biggest things. Don't invest. If it were me and I was new, don't invest in anybody new that this is their first deal, because they have no clue what they're doing and they're inevitably going to bonk their head, and we don't know how they're going to handle that yet. I wouldn't invest in anybody that has less than probably 20 deals under their belt, just because, right? And I would double, triple, and quadruple check their track record and that what they were telling me was true. I would also look to talk to a couple of their current LPs that had been with them on 2, 3, 4, 5 deals. And, if they're not willing to allow you to talk to a couple people as reference points, run, because there's no reason they shouldn't be able to. And that's it. And then it goes from there is just your gut feeling. But at some point, you got to get in the game, right? Once you've vetted an operator that you believe you trust, you've done your diligence on them, the best way to learn this business is get in a deal. Get in a deal. Get in the minimum investment. Some guys it's 50 grand. For us, it's 100 grand. Some guys it's more. Get in a deal, and then you're going to really know, right? Because now you're in it. You're going to see the reporting. You're going to see the communication. You're going to see the cash flow. You're going to see how it works. And then you can just, and here's the other thing I will say. We have people that come to us and they're like, Adam, I have $1 million that I want to invest in these types of deals. What should I do? And I say, don't give that to me for one deal. Let's do one deal together at the minimum. Make sure we like working together, and I do everything that I'm telling you I do, and save your $900,000. And if you feel that we perform for you over the next few months, then let's spread that over the next 9 deals. And they're like, thank you so much, right? It'd be easy to be like, oh yeah, sure, put that in my deal. That is not responsible. I would highly suggest you do not do that. Invest the minimum. Make sure you play well together and that they're, honest people that you're working with. And then once you've done that, I would stick with that operator. Some people are like, well, I like to put some with this one and some with that one and some with this one. If I find a winning horse, I'm riding it, right? I'm not writing one deal, but I'm going to invest in every deal I possibly can, because now let's say I'm invested in 10 or 12 or 50 of these things over time, and one goes bad, which inevitably one will, right? It's not perfect. One goes bad, I don't even feel it. It's like, okay, cool, that sucked, but what did I learn from it? And hey, I still got a good horse here I'm riding on where, we've done 30 of these things and one went bad out of 30. These guys are still awesome. I'm going to still ride with them, right? So those are just my pointers.
No, I think those are great points. I think the thing that's forgotten a lot is that from a fund manager side, that goes both ways, right? I obviously, as a fund manager, I like to raise as much money as I can, but for people that I've never met before, I prefer to take the minimum investment right up front, because it's a heck of a lot easier to unwind a minimum investment to get them out if we don't see eye to eye and it's going to be painful to work with them for a long time. And if they give me a huge chunk of change and now I'm basically married to them for X number of months, our minimum is 6 months, but it doesn't matter. My life is very valuable. My time is very valuable to me. And I want to work with people long-term that I like and I want to be with. And if someone's going to be a giant pain in the butt, then I'd rather them find somebody else to work with. And I think that goes both ways, from the manager side and the LP side. And LPs sometimes just forget that, there has to be a good collaboration between the two, because it's a partnership.
I completely agree. For us, I tell everybody that comes into our world, our opportunities are illiquid while we hold the asset. So we gotta like each other. We have a very strict no asshole policy, and you should have the exact same. It goes both sides of the coin. I'm going to treat you with respect. If and when something bad hits the fan, I'm going to be the first one contacting you to talk through it and let you know what our strategy is to get out of that issue. Our communication is going to be exactly what I say, but I also expect you to treat my staff with respect. Don't be rude to them. Don't call in here with demands. Be kind, right? And in the same, like, we're in this together. Like, when we get involved with somebody, it's a minimum of generally 2 or 3 years, and we want to have them on board with us for 30 years. Right. So this is a long-term relationship. And that's why we've kept it very boutique and very, like, I golf with our clients. I go to dinner with our clients. Our kids know their kids. It's very close, like that. So relationships only.
100% agree with that. Question I ask all my guests on every one of our podcasts is, so knowing what you know right now, if you were to go back to when you were, say, 20 to give yourself advice, or if you have kids and could go forward to when they are, say, 19, 20, what piece of advice, based on what your current state of knowledge is, would you give them to help them, or give yourself to basically move them forward in life the best?
Yeah, I got really fortunate because I did start, 20 years ago, and I just dove in eyeballs deep to really understand what this world meant and the opportunities that presented. And then I took action on those. But I do have kids. My wife and I have 2 kids. We have a 7-year-old daughter and a 15-year-old son. And we are teaching them every single day what mommy and daddy do. And we are teaching them the value of what we do and how it can help you, because time and compounding is what makes this work, right? I said, this is not a get rich quick scheme. This is a get wealthy for sure blueprint, but time is on your side. It's never too late to get started unless you're close to dead, because then it really won't help you. Even if you're 50, 60 years old right now, and you're able to get in these deals, you still got 10, 20, 30-year road to make some real waves with this thing. And so I put, you'll never see me sell a course or sell anything like that. I'm not a coach, but I do as much as I possibly can to educate everybody I come in contact with and push content out on my social media at LinkedIn. And we're just starting to put out a bunch of long form videos and so forth on YouTube. I want to take all the knowledge that I've gained over the past and experience over the past 20 years, and I want to share that with the world. Because, Dan says it's best. One of my goals is to become the best version of myself and then share it with the world. And I want to give it all away for free. I'm not here to charge for any of that crap. Whether somebody comes to work with us or whether they go do it with somebody else, I just hope that they do it, that they take it and do it, because this will change your life. I'm telling you. And it won't just change your life, but if you teach your kids and the people around you, people are watching you. People are looking at what you're doing, no matter who you are and what you do. And if you can lead by example and actually do it, and then explain to your children what you're doing and show them the way, this can have a ripple effect for generations to come, right? Not only financially, but mentally. I see people all the time that are really hurting financially, and that puts a big strain on them mentally, puts a strain on their relationships. And I just hate to see that, man. It's sad. I don't think money is evil. I think money is a tool that can really put a lot of stress on you if you don't have it. So this is a vehicle that will get you there. I also end with this on this part. The robots are about to take over. Believe it or not, be adverse to it or not, I don't care. AI and the robots will take over. Everyone in the world will have 1 to 2 robots in their home within the next 10 years. I promise you. Landscapers are gone. Pool guys are gone. Pest control guys are gone. You're not going to be picking up your dog's crap anymore. Like, they're coming. They're coming. And it's going to be think about what you do for work these days. And is that going to replace you? Because a lot of jobs are going to get replaced. And you need to be able to have a plan in place to get off that treadmill. And passive income and these types of syndications, or what we do, is the only thing I know that's, nothing's a guarantee, but it's damn close if you put it in motion. So food for thought.
Awesome, Adam. It's been a real pleasure having you on. I appreciate your time. If anything you said resonated with anybody that's listening, or if they are interested in doing business with you, where can they reach out to just connect with you?
Sure. Yeah. On socials, Instagram, LinkedIn, it's at AW Invests. You can follow me there. You can DM me there. We're really on top of our stuff. You can also just go to my website, elavestcapital.com, and book a call with my team there. Generally, it's going to be me or one other person in my office, but I just love chatting with people. I'm happy to answer your questions. We do not sell anything over here. So I just like to get on the phone with people that are interested and help educate. And if we get together and do something awesome.
Again, it was a pleasure. Thank you so much. We will talk to everyone else next week. Thanks again. Have a great week.
Thanks, Loren.
Thanks for tuning in to Brick by Brick Wealth Building Conversations. If you enjoyed today's episode, don't forget to subscribe and leave a review. It helps more people find the show. For more tips, resources, and updates on my journey, follow me on Invest with Loren. Let's keep building wealth, one brick at a time. See you next week.